Welcome to another episode of Indochina Insight, where we unpack the socioeconomic stories shaping lives across the Indochinese Peninsula. Today, we're examining a subtle yet pervasive shift in everyday banking, the introduction of monthly fees on accounts that don't meet minimum balance requirements or sit idle too long. These charges, hovering between 5,000 and 22,000 local units, now apply at over a dozen institutions, targeting standard personal accounts to encourage activity and cover back-end costs like tech upgrades and data security. Once a free perk to lure depositors, they're now routine, in line with central bank pushes for cleaner, more active ledgers. Drawing from a December 1, 2025, report by Quỳnh Trang and VnExpress, we spotlight implementations at Eximbank with 11,000 units under 500,000 balance, VIB's 11,000 for 12-month dormancy, Vietcombank's flat 2,200, BIDV's tiered 3,300 to 5,500, and similar at ACB, VP Bank, LPB, ANK, Vietbank, HD Bank, and OCB. It's a policy bank say sustains innovation, but one that prompts reflection on who pays the price. For progress, let's rewind to see the transformation within the country. A decade ago, personal banking was a costless entry point, with zero fees. Drawing in masses account numbers ballooned from 20 million in 2010 to 120 million by 2023. Per state bank data, as average balances lingered low at 1 to 2 million units amid economic liberalization, inactivity was overlooked, building trust and inclusion. Fast forward to 2025. Post-digital boom fees phased in from 2022 pilots, with BIDV leading in May 2024 at 3,300 units, now widespread. The shift, a 22% drop in low-activity accounts by mid-2025, according to Vietnam Banks Association stats, alongside a 12% rise in closures among low-income holders, as household finance trackers from the General Statistics Office reveal, subtly steering users toward higher engagement or out of the system altogether. Zooming out regionally, this mirrors but diverges from peninsular patterns. Laos state-heavy banks like BCEL enforce 10,000 to 15,000 unit fees since 2022, shrinking retail bases by 12% per bank of the Lao PDR reports, in a less competitive space than Vietnam's dynamic market. Cambodia's Aclita hits with 5,000 to 20,000 for inactivity, pushing unbanked rates to 45% in the National Bank of Cambodia's 2025 index, exceeding Vietnam's 15% World Bank figure. Myanmar's KBZ varies up to 25,000 amid volatility, inflating dormancy to 30% per central bank data, while Thailand's Bank of Thailand limits to 100 baht with waivers, holding dormancy at 8%. Malaysia's Maybank uses 5 to 15 ringgit graduated scales with protections, limiting closures to 5% versus Vietnam's 10%. As ASEAN frameworks note, illustrating how Vietnam's balanced fees navigate growth but risk amplifying exclusions in a 60% low in a region. Per ADB metrics. Now, for a thorough exploration, consider the multifaceted layers of this trend, rooted in the peninsula's hybrid economies blending state oversight with market forces. Broadly, it touches 40 million accounts peninsula-wide, with Vietnam's 20 million low-balance ones bearing 0.5 to 2% income hits, compounding 2 weekly essentials per General Statistics Office surveys, legally sound under SBV Circular 19/2016's transparency rules. Yet the 30-day notice often misses digital migrants, as Vietnam Competition Authority filings show. Deeper still, fees underwrite 5 to 7% revenue for cybersecurity, per PwC's ASEAN Fintech 2025, but ignore cycles. ADB links them to 7% savings dips for informal sectors' 60% workforce, fueling 20 to 50% informal lending. In Cambodia, they spur 15% mobile money shifts. Laos sees 25% to savings circles per ministry audits. Myanmar hampers 80% remittance GDP amid 40% inflation. UNS cap notes. IMF 2025 consultations flag 0.2% GDP drags from reduced spending, with women 55% low balance holders. SBV data hit hardest on 300,000 unit household pots. Environmentally, fees enable green pilots but sideline subsidy-dependent farmers, per Rural Strategy Institutes. Gender and inequality threads weave through world inequality databases. Bottom 40% exclusions, underscoring a dual finance where top 20% thrive. Bottom language. To ground this in reality, listen to those living at the factory operators, market haulers, and fresh grads piecing together livelihoods. Picture a seamstress threading machines for 6 million units monthly, her account dipping below 400,000 after remittances, the 11,000 unit deduction vanishing like unearned over time. As labor union groups capture in their quiet testimonies, it's free until you're not rich enough, or the dual market vendor, her 200,000 units safety net eroded by 5,500 units, whispering in community chats compiled by inequality watchdogs, like patching a hole only to find another. Young freelancers, incomes erratic at 4 million, feel it as startup friction, punished for building from scratch. They post in ILO-tracked forums. Upland tillers, subsidies their lifeline at 1.5 million yearly, call it a wealth tax on the ground, leaning on village lenders at 10% monthly. From Policy Institute these narratives, from Oxfam's marginalized voices and anonymous threads, echo a fraying faith, banking as aspiration turned obstacle. For the toilers holding economies afloat. Turning toward brighter horizons. Envision mechanisms that have redefined access in thriving systems, prioritizing people over ledgers. Imagine auto waivers for modest activity to monthly moves paired with app-based rewards for small deposits. Interest nudges building security without strings, lifting engagement 25% in frameworks mandating such flex a generation back, or cooperative fintech outposts, levy funded from corporate highs to deliver 5 free basics via resilient kiosks. Slashing exclusion 40% in debt-weary island recoveries of the late 20th century. Advisory circles user lead within oversight bodies. Reshaped fees yearly via feedback, income capping at 1% medians and linking to joy metrics. Having gripes and expansive federations over half. Blockchain micro-shields bundle with accounts. Community pooling to offset hits for seasonal souls. Laced with mobile wisdom bites elevating savings 15% in liberalized East Asian shores. And baseline ledgers. Publicly anchored yet innovatively run, mandate-free with smart safeguards, dropping unbanked below 5% in Western blends of guardrails and ingenuity. Layered so, they reforge finance's ally, quietly kindling shared assent.